You've got $2 million in retirement savings. Congratulations. Now what? More specifically, what's the best retirement paycheck strategy if you've already done the hard part, built the portfolio, but now you need the money to replace your paycheck for the next 25 or 30 years? Because, folks, this is where things get real. You're no longer just saving, you're spending. And the wrong withdrawal strategy can do real damage, especially if inflation stays sticky or markets turn ugly early in your retirement. So today in the Retirement Income Lab, we're going to answer a very practical question and put $2 million in retirement savings under the microscope and see what the best way is to turn it into a retirement paycheck. I'm Patrick Huey, certified financial planning practitioner. Let's get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
Welcome back to the Retirement Income Lab, where high-saving professionals turn portfolios into paychecks they can actually live on. If you're within about 5 years of retirement or just getting into it, this is the series for you because we stress test real retirement income decisions so that you don't have to test them out there in the real world with your own life savings. Now, if you watch this and think, hey, that sounds like us, you can schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. Now, let's build a paycheck from $2 million. Now, a lot of people think the question is, how much can I withdraw? That's certainly part of it. But it's not the only question. The bigger question is actually, how do I withdraw from a portfolio in a way that can survive bad markets, inflation, taxes, and a retirement that just might last a lot longer than I imagine? Because if you pull money out blindly every month, as if your portfolio were a salary machine, you may eventually find out that the machine has a few design flaws. So a good retirement paycheck strategy has to solve for at least four things. One, current income needs, because duh. Two, inflation. Three, market volatility. And four, tax efficiency. And if you solve for only one of those other ones is going to sneak up on you when you least expect it. So let's use a specific example. We'll call this couple Michael and Susan. And as a side, I use Michael and Susan a lot because during our wedding, we got married in the Caribbean by Justice of the Peace, and his printer had broken. So he kept reading from the previous marriage ceremony, whose names were, you guessed it, Michael and Susan. Anyway, Michael and Susan are both 65. They both just retired. They have $2 million in retirement savings. Most of it's in IRAs and 401ks with some taxable savings as well. But there's no pension. It's 2026 after all. They're hard to find. And their combined Social Security is about $60,000 a year. They want to spend $140,000 per year before tax. So if Social Security gives them $60,000, the portfolio needs to produce the remaining 80. Easy math. And that gives us a clean starting number. 80,000 divided by 2 million is, you guessed it, a 4% starting withdrawal rate. Now, 4% is not outrageous. However, despite what you may read online, It's also not magic. Whether that works is going to depend heavily on how they invest, how inflation behaves or doesn't, whether markets cooperate, especially in the early years of retirement, and whether they have any flexibility whatsoever in their spending. And this is where strategy matters. So, what's best? Well, if by best you mean the strategy that gives me the highest possible income no matter what, well, that's one answer. But it could also mean, and I think it probably should mean, what strategy gives me a durable paycheck that can survive real life? That's the better question. Because the best retirement paycheck strategy is usually not the one that pays the absolute most in year one. It's the one that gives you enough income today, but enough growth for tomorrow and enough flexibility that one bad market year doesn't wreck the entire plan. And that's why I think a rigid paycheck can be somewhat dangerous. A flexible paycheck is often far more durable. And that's especially true because retirement doesn't happen in a vacuum. Inflation keeps moving, markets keep moving, taxes keep moving, and your spending may move right along with them. Think about travel. About two-thirds of seniors list travel and vacation as a top priority for their discretionary income and as a major lifestyle goal. I see this all the time in my practice. I've got clients who want to go to India and the Antarctic and maybe a few places in between that are somewhat less exotic. So what you spend on travel may be a moving target, pun intended, and fluctuate over the lifetime of your retirement. Now let's talk about inflation because we have to, because this is where many retirees make a major mistake. Some people hit retirement and think, I am done taking a risk. I understand the instinct. But inflation does not care that you retired. If inflation averages 3%, your cost of living roughly doubles in about 24 years. Think about that. Over the course of an average retirement at 3% inflation, your cost of living doubles. If it's closer to 4%, it roughly doubles in about 18 years. So if Michael and Susan need $140,000 today, they're likely to need well over $200,000 later just to maintain the exact same purchasing power. In most cases, that means they still need some stock exposure, not because stocks are fun, not because volatility builds character, but because growth is often necessary to maintain or expand purchasing power over a long retirement. If all $2 million sits in low growth assets, they'll feel great. They'll feel safe this year while quietly becoming poorer over time. Reminds me of an old Hemingway quote from The Sun Also Rises. When one of his characters is asked about how he went broke, he replies, gradually at first, and then suddenly. Now, here's the other half of that problem. Too much stock, too much exposure at the wrong time can hurt badly. So if your instinct in retirement is to blindly keep what you have because it's worked so far, listen up. If Michael and Susan retire with 90% in stocks and the market drops by 25% in the first 2 years, while they're also pulling $80,000 a year from the portfolio, that can put a real dent in their overall plan. And that's what we call sequence of return risk. Bad returns early in retirement are much more dangerous than bad returns later because you're withdrawing money and the portfolio is shrinking. So inflation says don't be too conservative. And I agree with that. And sequence risk says don't be too aggressive. And I agree with that too. And that tension is exactly why retirement paycheck planning matters so much. It's why we created the VIP Retirement Income Lab. So, what might a practical retirement paycheck strategy look like for a couple with $2 million? Let's build one. Michael and Susan need $80,000 from the portfolio in year one. One possible framework might look like this. Okay. Hold a year or so of planned portfolio withdrawals in cash or very short term bonds. That would be $80,000 or so. Why? Because if the markets drop, then they're not forced to immediately sell stocks and bonds to fund monthly spending. Notice I included bonds there too, because as the last few years have showed us, just because you bought a bond doesn't mean it can't drop in price. Second, hold another 4 to 6 years of spending in higher quality bonds. Okay, this is more of a bucket approach. Cash, bonds, stocks. Okay, that might be about $400,000 in bonds for this particular example. Now they've got 80,000 in cash, they've got 400,000 or so in bond, and the remaining portion is in diversified longer-term growth assets, read stocks. That works out roughly to, we'll call it 5% in cash, 20% in bonds, and the rest in stocks. Now, depending on their risk preference and their risk capacity, that might be a little spicy. Some couples may be better at 60-40. Some may prefer 65-35. And some may need even more reserves if they lose sleep easily because of their finances. The point is not that 75% in stocks is the one true religion. The point is that their paycheck is now tied to a structure. Near-term spending reserves, immediate stability, long-term growth. It's a system. It's not an improvisation. Now let's talk about the most important word in this episode, and that word is flex. Now, if you were just going to show me your bicep, calm down. It's not that kind of flex. The best retirement paycheck strategy is usually not completely fixed. It flexes a bit for real world events. For example, let's say Michael and Susan's $140,000 annual lifestyle includes $100,000 of essential or highly important spending and $40,000 of discretionary spending, things like travel and gifts. If markets do well, maybe they increase travel, help family, or make larger gifts. But if markets do poorly, maybe they trim the discretionary spending by 5 to 10% for a while. That might mean delaying a remodel, scaling back travel, or keeping the old car for another year. But it doesn't mean financial disaster. It means they know in advance what can bend without breaking the plan. And that kind of guardrail strategy can dramatically improve the durability of your retirement income. Now, what else can help that? Taxes, of course. Where the paycheck comes from matters just as much as how much comes out. Indeed, it may matter more. If Michael and Susan have money in traditional IRAs, Roth accounts, and taxable brokerage accounts, they may be able to build the same net paycheck with less tax drag by drawing from different sources in different years. That means the best retirement paycheck strategy is not just an investment strategy. It's also a tax strategy. As I've said before, if you've got a traditional IRA, you have a silent partner. His name is Uncle Sam. And if you ignore that partner while building your retirement paycheck, he may end up taking a lot more than you expected. So if you have $2 million in retirement savings, what's the best retirement paycheck strategy? Well, the short answer is this, not a rigid one, a resilient one. You need enough income for today. You need enough stock exposure to fight inflation. You need enough stability to survive bad markets. You need enough flexibility to reduce pressure in ugly years. And you need enough tax awareness to keep more of what you withdraw. In other words, the best retirement paycheck strategy is not take 4%. It's building a withdrawal system that can adapt when real life refuses to cooperate. Now, if you're watching this and thinking, we have the savings, but we don't really have the strategy for our paychecks, it's exactly the kind of thing we work on in the Retirement Income Lab assessment. I'm a fiduciary, a certified financial planning practitioner, and I'm the owner of Victory Independent Planning. And I work with high-saving professionals all across the country within about 5 years of retirement or recently retired. And in your lab assessment, we can map out your retirement income sources. We can stress test your withdrawal strategy, and we can identify how much flexibility your spending really has. So if you'd like a second opinion, just go to victoryindependentplanning.com/contact and schedule a short call with me. And if you found this helpful, please hit that subscribe button, subscribe to the Retirement Income Lab, and then hit the like button as well. You're going to help us find more people who will get value out of these conversations. In our next episode, we're going to do a deep dive and a special on inflation. Not just because prices are up. We're going to be talking about what inflation really does to retirees, why it quietly wrecks static plans, and what you can do to defend your purchasing power without taking foolish risks. Thanks for watching, and I'll see you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner, Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.